Today, we're going to break down one of LIC's most popular plans, the new money back plan. Now, it's designed to cover you for 20 years, mixing savings with security. But how does it really work? And more importantly, is it the right move for you? Let's get into it. So, let's start with the big question this whole plan is trying to answer. How do you find that perfect balance between protecting your family's future while also making sure you have access to some cash along the way for your own goals? It's all about security meets liquidity.
So what's the big idea here? Well, fundamentally, this plan tries to bring two really important financial goals: solid life insurance and regular, disciplined savings, and roll them into one single package. Let's see how it actually pulls that off.
Okay, there are three key things you need to know. First, it's non-linked. That's just a fancy way of saying your money isn't tied up in the ups and downs of the stock market. It's built for stability. Second, it's participating, which means you actually get to share in LIC's profits in the form of bonuses. And third, you get periodic payouts, and that's the whole money back feature, giving you cash at set times.
All right, so who is this plan actually designed for? Could it be a fit for you? Let's run through the eligibility checklist and see who can get in on this.
The rules are pretty straightforward. You can start as young as 13 and join up until you're 50. Now, the policy term is fixed at 20 years, but here's a really key detail. You only pay your premiums for the first 15 years. You stop paying, but the policy keeps working for you. The minimum amount you can insure for is 2 lakh rupees, but there's no upper limit, which gives you a ton of flexibility.
Okay, let's actually map this out. I think seeing the 20-year journey from start to finish, when you pay, and more importantly, when you get paid, is the absolute best way to understand how this thing is put together. This timeline just lays it all out perfectly. You're paying in for those first 15 years, but the plan is active for the full 20. The really important moments to focus on are those 3 money-back checkpoints at years 5, 10, and 15. They're designed to give you some cash for whatever life throws at you.
All right, now for the part everyone really wants to know about, the money. How and when do you actually get paid? Well, there are basically 2 main scenarios we need to look at. One where you make it through the full 20 years, and another for, well, if the unexpected happens. You can see here how the plan kind of has 2 different jobs. On one hand, it's a savings vehicle that rewards you for surviving the term. That's where those money-back payments and the final maturity amount come in. But on the other hand, it's a powerful safety net. If the policyholder passes away, their family gets a significant lump sum to help them stay on their feet financially. Okay, theory is one thing, but let's make this real. We're going to walk through an official example from LIC. Let's imagine a 30-year-old who takes out a policy for the minimum amount, which is a basic sum assured of 2 lakh rupees. So first up are the survival benefits. These are guaranteed payouts you get just for staying in the plan and reaching certain milestones. You can almost think of them as a little reward for being a disciplined saver.
The first payout comes at the end of the 5th year. You get 40,000 rupees, which is exactly 20% of that 2 lakh sum you were assured. Simple as that.
Then, like clockwork, 5 years later at the end of year 10, it happens again. Another 40,000 rupees comes right back to you. And you get one more payout at the 15-year mark, right around the time you're making your very last premium payment. So get this, that's a total of 1,20,000 rupees that's already been paid back to you before the policy has even matured.
But that's not the end of the story. Now we get to the grand finale. If you successfully complete the entire 20-year term, you get the biggest payout of all, the maturity benefit. So, this final amount is a mix of things. You're guaranteed to get 40% of your sum assured, which in our example is 80,000 rupees. But on top of that, you get the bonuses that have been building up over 20 years. Now, these are variable, they depend on LIC's profits, but they have the potential to seriously boost your final payout. Okay, so we've been talking about the savings side of things, the happy path, right? But remember, this is also a life insurance policy. So let's shift gears and look at that other critical scenario and see how it protects your family.
Now, this right here is probably the most critical feature of the entire plan. If the policyholder passes away, their nominee gets the sum assured on death, which is actually higher than the basic sum, starting at 2.5 lakh rupees in this case, plus all the bonuses earned so far. And listen to this because it's so important. This full amount is paid out even if you've already received all 3 of those money-back payments. They don't subtract a thing.
But wait, there's a little more to it. The plan doesn't just stop with the core benefits. You can actually customize it with some optional add-ons, and it comes with some really useful features that give you a lot more flexibility.
For a little extra premium, you can add what are called riders. Honestly, the best way to think of them is like power-ups for your insurance policy. They can give you much bigger payouts for specific situations, like accidental death or disability, really beefing up that financial safety net for your family. And these two features are all about giving you options when life gets messy. The loan facility means you can borrow against your policy's value if a real emergency pops up. And the revival option, well, that's your second chance. If you fall behind on payments and the policy lapses, you've got a huge 5-year window to get it back on track. Okay, so we've looked at the structure, the payouts, who it's for, and all the extra features. That brings us to the big question, right? After all of that, what's the final takeaway?
Look, if there's one thing to remember about this plan, it's this. Its #1 priority is safety and predictability. The goal here isn't to get you crazy high-risk market returns. It's about providing a steady, stable foundation for your savings, all while wrapped in a solid life insurance cover. So it all comes down to this. This plan offers a very structured, very disciplined 20-year journey. It's for people who value guaranteed cash flow and peace of mind over the roller coaster of high-risk growth. So the only question you really have to ask yourself is, does that steady, methodical path match up with the kind of financial future you're trying to build?